Recent media coverage about mortgage brokers has been quite negative, with allegations of poor ethical standards and falsified data being used by some to bolster loan applications. So, in our latest video blog, we look at data from our household surveys to portray the current state of play. To begin, mortgage brokers have become a significant feature in the mortgage industry. Indeed, almost half of new loans are now originated by brokers. Different household segments have different propensities to use brokers. Those seeking to refinance, first-time buyers, and property investors are most likely to use a mortgage broker. We expect this growth to continue thanks to the growing appetite for refinancing and the focus now apparent among major banks. For example, CBA in their recent results reported to December 2015 that 45% of their new loans came via the broker channel, up from 40% a year earlier. In addition, regional players and credit unions are using brokers alongside foreign banks operating here and the non-bank sector. Commissions have been tweaked recently, and the industry commission take is now back to pre-GFC levels after adjusting for inflation, because whilst overall commissions were trimmed, volumes have grown significantly. Remember that brokers get a commission payment at the start of the loan, as well as a trail paid in subsequent years. The bigger the loan, the bigger the commission. Very few aggregators normalise actual commissions paid, although Mortgage Choice does, so they claim that their brokers are less influenced by different commission structures. Some other brokers, for example Peach Home Loans, refund a proportion of the commission from the lender back to the borrower. But who is the broker working for? While some are directly employed by banks or aggregators, most are self-employed businesses. They're mostly aligned to aggregators to get access to their lender lists and to various tools and calculators. As a broker, they want to do a deal, and thanks to ASIC's responsible lending provisions, they need to consider the financial status of an applicant to ensure that the loan is not unsuitable. This is quite weak protection, because suitability may depend on many factors, including financial sophistication of the potential borrowers, income and expenditure assessments, and other elements. They do not have to identify the best deal across the whole of the market. The list of lenders a broker may consider will depend on the lender panel they have access to. Most brokers will access a restricted list of potential lenders, so cannot offer a whole-of-market view of options. Quite often, they will use online tools with a client to come up with the best deals, although often the basis for selection and recommendation is vague, and it is not fully disclosed. Some brokers are very proactive when it comes to shepherding the loan application through to funding, others less so. And some brokers will also keep a diary note to instigate a possible refinance conversation down the track. APRA recently said that they considered loans written via brokers to be more risky than loans written direct by the banks. So we decided to analyse our current household survey data, looking at relative risks between third-party broker and first-party bank loans. We tested risks by asking households about their perceived sensitivity to interest rate rises on their mortgage loans. The results show that households who originated loans via brokers have less headroom and more exposure to potential interest rate rises should they occur. For example, among owner-occupied first-time buyers, 28% of those who got a loan direct from the bank said they would have difficulty if rates rose from their current levels, whereas for owner-occupied borrowers via a broker, this rose to 43%, a significantly higher proportion. Further analysis showed that on average, loans via brokers were made at a higher loan to value and higher loan to income ratio than those direct via the bank. There was a similar, though less extreme, shift in risks across all owner-occupied portfolios, with 40% of borrowers direct from a bank saying they could cope with more than a 7% rise in interest rates, compared with 20% for those via a broker. Looking at refinanced owner-occupied loans, we again saw a higher proportion less able to cope with a rise in rates among households who got their loan via the broker channel. On the investment property side of the ledger, amongst those with multiple properties in a portfolio, we call those portfolio investors, there was a higher proportion who would be exposed by any rate rise amongst those going direct to a bank compared with a broker. But the difference is quite small, and combined, more than 40% of portfolio investors would have issues if rates rose. This is because they are highly leveraged. When we looked at all investment loans, we found that households who obtained a loan via a broker were slightly more likely to be under the gun if rates rose, and a significantly high proportion of borrowers who went direct to a bank were confident of handling a rise of more than 7% from current levels. Consolidating all the results, we conclude that households who access loans via brokers have on average less headroom to accommodate rate rises, compared with those who went direct. So in summary, mortgage brokers are an essential element in the home loan landscape. But to be clear, whilst many brokers give good advice, they are in an era of potential conflict thanks to commissions and limitations thanks to the panel structures. Brokers should be disclosing potential commissions and also their selection criteria. The alleged poor conduct amongst brokers falsifying applicant data is in our view a marginal activity of just a few bad apples. That said, consumers should be using a mortgage broker with their eyes open. Ask yourself if the broker is truly working in your best interests. I'm Martin North from Digital Finance Analytics. Thanks for watching.